All right, good afternoon, everybody. This is Event Trader here on a relatively slow afternoon, being joined by Brett Manning, who is, of course, Chart Trader. Brett, you with us?
Sure am, Gav. How you doing?
I'm doing good. Happy Tuesday to you. A little bit a day late on the start today, but I don't think we missed terribly much. And to be honest, I'm kind of happy we got at least one session post G20 to get under our belts to get a little bit fairer idea of some of the sentiment. But
Right.
I figure we might as well start there with the G20 since we last talked. That's easily the biggest event that's crossed the path of the news wire. So, what are your quick thoughts on the G20 and what came out of it?
I think that we have managed to create a narrative where there's a window of opportunity, or at least apparently so. But I think that really we're going to have to find out what this means, because it feels like a place that we've been a number of times, and none of which have actually turned into fruit. So
Right.
we'll just have to see. I mean, it's an evolving situation, but the market can say at least there is a window of opportunity if we do have a situation where both sides have been through enough to start to come to some kind of resolution, and we'll see.
All right, so I think one of the more interesting aspects of this is with the G20 in the rearview mirror, at least for now, there'll certainly be continue to be a key theme because we do have to see some concrete steps, I think, in order for this G20 meeting to count for anything. Certainly we saw a quick pivot over to Europe. Granted, it was only on $4 billion worth of goods this morning, but tariffs are going to remain in play. But one of the key things that I saw in the Bank of America Flow show, Brett, and you highlighted this, I believe it was your Friday morning comment, was this comment here, saying positioning has never been this negative amidst such strong equity and credit returns. And then they go on to say, we still think the pain trade is very much up so long as recession and trade war escalation is avoided. Now, I would have agreed with that wholeheartedly. So that's why we're kind of in this position now where we saw that big pop after the G20, but we haven't been able to do much with it. In fact, we've given up nearly most of those gains. So you got any thoughts on the price action that we've seen following the G20 meeting here?
Yeah, sure. I think the context, and remember that statement is hard data.
Yeah.
I mean, this is data from their prime brokerage and their client accounts for large money managers. That's positioning is extremely conservative relative to the performance of assets, and that's just an objective fact. So and that means that there is the vulnerability of conversion. If you think of the concept of a trend being the process of converting the non-believers, that's what pushes asset prices further. How far have we gone? Well, we've got a lot of non-believers to still convert. Doesn't mean the context will come along to convert them. But I would see the current environment. So I think that, just to take a step back, I think that from a top-down trading standpoint, June was a really spectacular month.
Yeah, and in fact, it was the best June in 60 years, right?
Well, I don't just mean in terms of how the market performed. I mean in terms of the trading opportunities from somebody who approaches markets, for instance, the way that I do. There was a lot of T-ball setups, and it was a very productive month in terms of the types of signals we had, in terms of the lean that we had, in terms of the big moves that we had in a number of different assets. And July, I really see July as a possible landmine for people who gained some capital momentum in June and now feel invincible. And to speak to your point about the sort of stall here and that you think things are primed, I think that one of the things that we're going to have to deal with, and I'll get your thoughts on this, is that we're heading into earnings season now, and that's going to take over a little bit. And I think that it's probably going to be an earnings season where you've got a lot of companies who see an opportunity here to sandbag expectations on the basis of uncertainty around trade. And that probably means that if there are people who are ready to start to become more exposed to equities, they might want to wait until some of that news has already been digested into the market before starting to push money in. So even if there's money that's on the sidelines, even if people are too defensively positioned, exactly how they go about tactically solving that problem, given where we are in terms of the timing of the earnings calendar, it may be a situation where we're talking about, let's get through the first couple weeks of earnings season, let's get through the process of getting that tone out there of companies starting to guide down because of uncertainty around trade, and kind of putting that message out there to sandbag future expectations. Once that's out there, then the money may start flowing in, because at that point, what we've got in front of us is potentially another rate cut and potentially a trade deal with China. And if you've got a lot of people who've got money on the sidelines, it's going to be interesting to see. I may be wrong. Maybe they'll just plow through this. But I feel like that's a reasonable expectation, which would suggest maybe a couple weeks of really narrow ranges and not much movement.
Yeah, which would be off from the history that we've seen in the past around strong Junes. We could break into that in a minute, but I guess we'll look at the earnings side of things first, right? And one of the key things with all the strength going on is one thing that I saw from the sentiment site was that the average year-end price target for strategists never changed, and that was at 29.12, which obviously we're 57 points above that. So still pretty bullish sentiment out there when you're looking at Wall Street strategists. Then when you break into the earnings, one of the more interesting aspects that I saw was analysts have downgraded their estimates on 116 more stocks than they've upgraded estimates in the S&P 500. It kind of highlights the concern and the caution around.
Over what time period?
For this upcoming quarter, for Q2.
Gotcha.
So this would have been over the last 2-3 months. No, this is actually just for the month of June, where analysts.
Okay,
so analysts have been slashing their estimates going into this. Not uncommon, but it's certainly lowering the bar. But this was the second worst reading ever for June, and the second worst for any quarter end month in 4 years.
But it poses the fundamental kind of battle, right? About a dispassionate fundamental analysis versus what the market's actually doing. Again, you can look at economy slipping, things turning over, people bearish, market goes up, analysts downgrading stocks, market goes up, etc. And historically, that's tended to be something that the market wins on, at least over the near term.
Yeah, when I was looking through the numbers, it was significantly in the market's favor to rally. The last time was Q3 in 2013, where we saw a number like this, and that ended up leading into a nice surge in the markets. And that's what I was going to throw out to you, Brett, is we've talked a lot about the position that's going on, and we'll break a little bit more into that. But also, we have the idea, and I think Micron kind of highlighted this in terms of a stock that had really low expectations, comes in, beats its quarterly numbers, and then guides better than feared for the next quarter. And then we, of course, saw Micron just rip higher from 32 to up to 41 following those results. Certainly the G20 news helped, but that's one of the things that I'm starting to wonder, and I'll throw at you, Brett. Do you think that maybe expectations have gotten so low and the bar so low that it's just kind of leading to a little bit more kindling on a potential fire here?
Now, I think that Micron is a little bit of a special case because of some of the capacity problems in that sector specifically.
Sure.
Right? I mean, there's been a narrative there about the sort of semiconductor.
Yeah, a deeper narrative there for sure.
Yeah.
But it's also been at the forefront, and
absolutely,
a lot of the narrative and the weakness there is because of the trade war.
Absolutely. Right. But I mean, there's also a cyclical issue.
Yeah, fair enough.
Supply demand with semiconductors that has been in the down cycle period, and so maybe it overshot, augmented that sentiment. But yeah, I think that there's certainly a vulnerability. I mean, if there's and that's where you learn. You learn. I mean, it could be that we're headed into the next phase of the cycle, which is a big. I like to use the analogy of the bloom on the stem. It's as many times cycles have at a certain point, and it's possible that there's something percolating under the surface that's going to cause a lot of better than feared guidance, a lot of better than feared results right now. That's just telling us something, but it just seems so it's like such a reach to start to build that into expectations. Obviously, it's a vulnerability. It's definitely a vulnerability, and I guess again, here's what we'll learn whether or not that's happening. But I don't think that needs to be happening under the surface right now to still get the next leg of this kind of pain trade rally. But yeah, obviously that would be an accelerant.
Well, with that too, let's talk about some of the position that we saw in the commitment of traders number. First, I want to talk about indices and a quick aside on gold, just because I know you got that nice gold position that's bubbling up there. And one of the things that was sticking out for me was in the major equity indices, the smart money hedgers under the COT had gone from a 20 billion net long position to 40 billion net short in the prior week. The only other times they went from plus 20 to minus 40 would have been back September 18th of 2012 and July 19th of 2016, which both had some poor risk reward over the next 2 to 3 months. So again, the question is, do you think this smart money hedging is playing it right, or do you think, again, this adds a little bit more kindle into the fire?
Well, so first off, when you look at hedger data and CFTC data, with the futures market, the one fundamental point you have is that it's zero-sum total position. So it's got to all add up to zero, and somebody's got to sell to speculative money. So that same switch is speculative money coming into the futures on the spec side, and I think that that's possible. That can be chalked up to something that's maybe a little bit difficult to trace in the data of people trying to get index long exposure because they don't have a portfolio. And so it's classified maybe as a spec position on the long side, and those positions are being achieved from buying to commercials who are selling them. And in finance, in the financial sector, the commercial hedgers are financial firms with essentially an inventory of financial exposure to be able to accommodate that. They're almost market makers in this sense. So I think it's possible that we're seeing index instruments, which kind of reverses all of these terms, as kind of an upside hedge, as kind of a sense of people who have held a larger cash position and the market's performance and breaking out to new all-time highs and the Fed starting to shift. So I mean, it is part of the process of converting, and maybe converting through sort of fear of missing out or fear of being under-levered to benchmarks that are eventually going to be on a comparative basis somebody's real goal, and the sort of Damocles hanging over the head for asset managers with clients they have to deal with. And I think that index instruments, particularly leveraged index instruments, are a way of kind of trying to gain some exposure here just in case you get that next leg of this rally, and the fact that shift has happened on a week-over-week basis, I think that it does tell the story of part of the process. But I think that that's a step in the direction, and it feels like, given the degree to which, and this was cited by the Bank of America information, given the degree to which there's underexposure relative to asset performance, probably unless we have some serious and obvious fundamental downturn, there's more steps to go in that same process. And I guess my mental map is just kind of to watch for the timing of that to be something that tries to sidestep the negative flow around earnings season if that's kind of headed our way. I don't know if that fully answers your question, but that's what I think.
Yeah, no, that definitely does. And then aside on the commitment of traders, Brett, that I found interesting, of course, I've had a nice position in gold now. When did you first take that up? In January? I know you've been in it for a few months in the GLD, and then you played the futures, and you're out of that from my understanding, right?
Yes, so I bought GLD in April around 120, and then the day of the Fed, after the Fed, I felt like we were nearing a breakout, so I bought into the futures at 13.53, and then I got out of that with the final piece out at 14.36, which was my predetermined outside target. So it was always the plan, if I could get it, to have leveraged futures exposure for the actual breakout move and what I call the order cascade. When you've got a big level like that built up, there's a kind of inevitable process of orders cascading each other when you start to trigger the breakout. And I wanted that's sort of the highest conviction point. If in the long term the pattern fails, that process is still going to take place. And so that's when I want my leverage on the most. And now I've still got the same GLD position I had since last April, and I'm committed to watching the pattern develop and to holding that. If I start to see, let's say over the next week we see large spec positioning in CFTC for gold go up to 350,000, I'll probably get out of that.
That's where I was going to lead. So from my understanding, I was seeing most shorts are betting against gold since September of 2017. So
Did you see this?
This was in the COT data in a report that I was reading.
Oh, you're looking at commercial hedgers.
Yeah.
Yeah, right. And
So,
again, I kind of look at that as for me, the large spec number is usually more important than the commercial hedgers because one's making the market for the other. But the speculative money, the commercial hedgers in this case for gold in particular, you've got miners. Right. I mean, that's pretty. They've got the gold
yeah.
in the ground and they want to sell it. So it's not really short interest. And I think that sometimes on Sentiment Trader, the way Jason characterizes that is a little bit misleading because it's different for each market. And in the case of commercial hedgers for gold, it's plainly the case that you've got people who own a lot of gold that's still in the ground. If I own a gold mine and I haven't yet invested in the energy and the manpower to pull the gold out, but I still own the land and I've still had it assayed and I still understand there's such and such number of ounces below my feet when I stand in that property, then I understand that there's a future value to that. And if the market rips to the upside, what I do to sell that is I start selling futures contracts. And then all I have to do is mine the gold to take the other side of that. So I'm able to sell future production now if there's a dramatic increase in price. So in some sense, it's like shorting it because it's skepticism about a future continued rise in price, but it's not the same thing necessarily as simply betting against the market in something like gold. But the long speculators are in fact speculative money betting on future upside in gold, and that has grown. So it's not necessarily that this is tipped into a squeeze situation, I guess is my big point. But we've only grown that number on the large specs to like 230,000. And at lower prices than this, we've seen over 300,000 net long in the past. And it's a reasonable benchmark to kind of see a divergent situation there, which suggests to me that the trend could relatively easily have further to go, which is why I'm still holding on to the GLD.
Right. Now, one of the things that I was looking at was whether or not this could turn into a failed breakout. And obviously,
Right.
we just
That's
had
the key.
we had the Mester comments come out earlier. A non-voting member, but certainly something of interest. There's talk about the IMF's Christine Lagarde perhaps being the next ECB president,
Right.
which I wouldn't call her a hawk, but she has been in the camp at least in late 2018 of the raising interest rates inevitably. So, and then of course, the G20's cooled off a little bit. We got some of the tensions between the U.S. and Iran. I guess we could say cooling off, certainly not to the heightened tension it was 2 weeks ago. But we've definitely see a pullback on some of the risk on offsets. So what would be some of the triggers that you'd be watching in this gold trade, Brett, that would kind of put you on alert that perhaps this is a failed breakout?
Okay, so I mean, the most simplistic answer to that question would be too much bullishness for what the price is doing, which shows me, by contrast, what's happening under the surface of the tape. We don't see that yet. But to unpack some of what you were also discussing, for one, I think that the Mester comments are interesting, and I posted a little bit about this because I believe, without necessarily perfectly obvious objective evidence, but a lot of kind of intuitive processing and a lot of experience, that the Fed seems to go through this process where when expectations get tilted too far toward a particular outcome for a particular upcoming Fed meeting, you start to see things like that Wall Street Journal Mester piece, which are, I think, designed to remove some of the
To
absolute
see what the
certainty
market
of
will do. Yeah.
to see what the market will do, but also to carve some space. They can't go into that. They can't go into the quiet period in front of this meeting with 100% expectations of a cut, and
Right.
and really just feel like
Just
they
back
are
them into a
absolutely.
corner and then get a ton of good economic data.
Who knows what? Right. I mean, maybe they just talk about it and they're just, it's just irresponsible to cut now, but we have to now because we weren't able to tamper those expectations, which means we're going to come out, we're not going to cut, the market's going to tank by 4% or something, and there's just going to be a riot. And, I think that they just, by historical process, I think that they've just become really averse to that kind of experience, even if it might be good in the long run process of the market to go through that a little, every once in a while. I think that in the moment to ask the people who are actually in charge of it, especially this Fed, with this White House administration and the relationship between the two to kind of, really put on display the almost caricatured kind of example of exactly what would really throw all of that independence question into sharp relief. I think that probably they're going to want to work really hard to carve out at least some space, even if they plan to cut. It's 100% cut with a quarter of that at 2 cuts. There's just not even a drip of an expectation in the market that they're going to hold rates at the end of July. And I think that's something that they're starting to feel like if we've come to a trade truce and if we start to see some good economic data points over the next few weeks, and, who knows what conversations they're having with major companies behind the scenes, which certainly does go on, they may start to feel like this is really going to be a long-term problem if we start to cut interest rates right now. But we've got to get some of that into the market first. And I feel like we're going to see that. I think we're going to see more of that over the next week or so, just trying to put out something to put that in doubt.
I think part of this pullback here is people starting to doubt.
Not showing up in the Fed funds futures, I'll tell you that.
It's definitely not showing up there.
Not showing up the bond market.
But I think that's leading to some of the profit taking that, and a little bit of profit taking ahead of Q2 earnings too. I think it's both kind of been a part of this, and but at the end of the day too, this pullback hasn't been necessarily overly concerning. I think if we broke back down below where we were on the close Friday night, right, I'd be a little bit more concerned about it.
Yeah, but, nothing going.
But yeah, I mean, perhaps you'd like to see a little bit more of a rally on a holiday week, but I don't find this move all that concerning given the context of the potential for the Fed funds to not see that rate cut, and again with that Q2 downgrades that we've been seeing too. So curious to see the market holding up really well. I don't want to say climbing a wall of worry, but certainly seems to be dismissing some potential, I don't know if we call it headwinds. Certainly the earnings are headwinds. I don't know if I'd call the central bank a headwind at all.
Well, one of the things that I think intervenes in what you're saying right there is the positioning, is the
exactly.
flow show report. I mean, that's why we're doing this show. That's why we look at this data, because the pre-potency
and that's the point
of
that
a trapdoor fall is really low right now.
And that's the point I was getting to in terms of that comment that we started off the show with. I mean, that just kind of shows,
exactly.
We're not far from the all-time highs, and you would think that we were in the midst of the Great Recession or something, I would think.
Yeah.
One piece of flow data that I saw that was of interest, and that was EU equities saw an inflow. I'm looking for the exact number. It was the first inflow in 20 weeks. Now, it was only about 100 million, so it was a very minute business. But do you see sentiment kind of warming up around Europe and perhaps emerging markets too?
I mean, I don't know if that's a case of it can only get so bad.
Yeah,
in terms of EU, but yeah,
certainly from a valuation standpoint. The dollar's
changed. Now there are ramifications to the Fed moving to an easing bias as far as the dollar and where emerging markets are concerned. So I can see that pretty easily explicable in terms of forecasts about the dollar, let's say 6 months from now. But EU equities, a little different, and I suppose that there's probably a lot of specific idiosyncratic factors that are at play there. But the emerging markets shift, I think, is relatively explicable on the basis of the shift in the tack from the Fed and the dollar no longer being in what appears to be a plodding uptrend.
Where do you think the easier money is going to be made over the next 6 months, Brett? In the U.S. or overseas?
So my guess would be in Japan and Europe, but it depends on where money goes. I mean, that's where, if you've got, value fund money that's been on the sidelines, I think that it would have to go there. But, there's an argument to be made for a barbell exposure in terms of momentum and value in this kind of situation. So, my simplistic answer, I would have a gut feeling toward convergence, which is the same, thing that we've been discussing quite a bit.
Yeah.
Convergence versus divergence in the U.S. versus ROW, or rest of world. And I would be favoring a convergence framework right now, but I'm certainly not stacking bets on that basis that can't be quickly switched.
All right, now taking a look at some of the sentiment data, Brett, there wasn't much that was sticking out to me in terms of what we were looking at last week. One thing I would probably point out was that NYSE high-low ratio, which popped up a little bit, but there tends to be a little bit of volatility around that. Were you reading anything into that particular sentiment reader?
No, because it's really not a contrarian indicator, even though it's positioned in sort of the list of sentiment measures when people start to see that, on any given stretch of a couple days, if 96% of the ratio between new highs and new lows is in favor of new highs, some people believe that's a saturation of buying potential and a pullback is necessary. But if you look at the long-term chart, it just doesn't bear out. You get long-term rallies that begin with that process, and with the market sitting at 80 to 90% new highs to new lows for the first 3 months of a rally that continues for another year. So it really doesn't work as a selling signal. What I find the best way to use that indicator to me is if you look at a longer-term chart of just the oscillation of new highs to new lows, and you just kind of squint your eyes a bit, you'll see a sort of center of gravity of that measure. And it will stick around the highs for a period and then flash down to the lows and then come back and then stick around the highs again. It's a good way to just encapsulate the deeper concept of what a bull market or a bear market is. When you start to see which side of that is stickier in terms of that center of gravity of that measure, you understand the trend, and then you understand when there's short-term sentiment indications the other way, those are opportunities to play back in the direction of that trend. And it's one of the things I use to define a context. And so it sounds easy, it sounds obvious. Of course, we're in a bull market. The market keeps going up. But if you really drill down to the moment-to-moment experience as somebody deciding, you lose sight of the kind of the real, where the tide is versus the current or the ripples. Or the waves of the ripples. And in this case, when you see it sticking around new highs for long periods of time, and then just flashing down for a week or two to new lows, and then coming back and sitting there again at new highs, it gives you a stronger sense of what's really happening in the larger context. But I will say this also. I think this type of indicator, breadth indicators that use new highs and new lows, were probably much more useful 10 or 15 years ago. I think there's, due to indexing strategies and ETFs and passive investment strategies, I think that the correlation rate has gone up a lot. And if you think back to, let's say, 20, 30, 40 years ago.
Is that because too many names are across too many ETFs that them going to 52-week highs doesn't provide as much of a good read, basically? Is that what you're saying?
It's that they're just not operating independently. They're more connected, by money flows into index instruments. But if you go back 30 years ago, there were completely separate patterns, even in the biggest stocks. Like one stock would be in a total breakout uptrend while another one was in a bear market, and they would, even if they're important stocks, there was much more differentiation among the herd in terms of what stocks were doing. So when you see new highs versus new lows, right now, if we get a pullback in the whole market, nothing's going to be making new highs because everything is moving with the market. And so that next day, there's just little chance there's going to be more than a handful of stocks able to make a new high because the market just pulled back, let's say 8 or 10%, like we saw earlier this year. That larger pattern that you see in the S&P and the NASDAQ will determine the possibility of those outcomes. And so maybe there's a few industries that are a little bit outside of that, and they're kind of moving off on their own. But I think this sort of data point was really much more useful a decade, 2 or 3 ago. And it's become less useful because there's the patterns. I mean, if you think about what a new high is, it's a new 52-week high. And if the market is just pulled back sharply and everything is kind of correlations are high, then it would be a gargantuan single-day breakout for something that's highly correlated to the index to get all the way to a new 52-week high. So it's really that everything's kind of herded together much more tightly now that I think removes the utility of that kind of indicator. But it still does work, I think, to be just kind of a contextualizing indicator. If you're willing to just kind of squint your eyes, take a 30,000-foot view of it and see where the bulk of readings are happening. And the bulk of readings right now are unquestionably still happening at new highs. And that shouldn't be too much of a surprise. And that defines the context as something where short-term sudden bearishness and negativity ends up being a buying opportunity more likely than that you should be sitting there trying to fade this every day.
Okay. One other set of sentiment data that came out since we last talked, Brett, was, of course, the PMI numbers, which were out yesterday. Certainly a lot of worry going on there. And again, this kind of plays into the whole weak soft sentiment, but the hard data and the price action just doesn't fall through with it. Did you see anything in the PMI commentary that was jumping off the page to you?
No, it's just more of the same, right? I mean,
Yeah.
we saw a lot, particularly in Europe, that was undershooting low expectations, which is
Yeah, Europe was certainly sanguine, but the data out of France keeps looking good. So that EWQ, I know that's one trade that I've got for a European turnaround. That's probably one of the first places that I'd go. But yeah, nothing from the PMI data was really changing the narrative on anything here. There is a feedback question, Brett, and we'll discuss this. So it says, besides the Fed not cutting rates, what things would potentially take the market down? Does the Fed not cutting rates also mean that things are great and that the market goes higher? So a Goldilocks scenario. So for my take, certainly an overly cautious Q2 could weigh in, and this is just removing any geopolitical concerns. Not looking for, we keep the status quo with where we are at on trade talks right now, because obviously if we saw the trade tariffs ratchet back up, that would certainly be something, but that's a little bit of low-hanging fruit. So for me, it's all going to be about the Q2 earnings and the forward outlook and whether or not people think that this is just, again, cautious sentiment or if this is something a little bit more real and in a cyclical downturn. I would say that's probably the biggest risk to the market. Is there anything? What do you think is the biggest risk to the market if the Fed doesn't cut rates? Is that going to be one of it, or will people take that a little bit more positive?
Well, let me parse the question differently. Let's say whether or not the Fed cuts rates, where's their vulnerability? Because I'm not so sure the Fed not cutting rates, if it properly builds in expectations, that could be something that the market digests reasonably okay, because the idea is that they just haven't seen enough trouble to cut rates, which just moves the rate cut to September and then on, and you just have a Fed put situation. So I think that the Fed
meaning
rates,
by any bad data, you're going to get buyers in because of the Fed, right?
Yeah, that you can always. I mean, rate cuts are best when they're just in front of you. When they're behind you, they're not so great. Yeah. And I think that constantly pushing that just into the future might actually help the market. It doesn't necessarily mean that things are fine. It's just the sense that it's tough to sell your positions if you're long, if you feel like there's always a rate cut just around the corner. So once it happens, though, that's no longer the case. The rate cut's there. You might as well start selling. So there's that possibility. I think positioning doesn't support the selling after the cut. But I think besides that, let's take the Fed yes or no kind of a little bit out of it. The thing that I think is actually the largest overall vulnerability, because it would confirm the sideline money, is if we start to see weakness that has nothing to do with business confidence. If we start to see weakness in consumers, if we start to see evidence that we're starting to see a generalized economic downturn that is irrespective of analysis of risks of supply chain based on the trade war. Right now, it's been confined to, I would say, business investing and business confidence and understanding of what the trade war is going to do. But
that's what's going to make this ADP and jobs number a little bit bigger.
Well, it's important, but we still may see bad data here that's just businesses not wanting to expand headcount because they don't know where such and such is going to go. It still could be part of that, but yeah, I mean, if it's bad,
but also on a slowdown of orders too is possible. I mean, also on a slowdown of orders. I mean, two of the weakest areas, of course, have been retail, which has been seeing a bit of a slowdown, obviously, and industrial too. That's been two of the weaker jobs areas over the last couple of weeks.
Sure. No, yeah, right. And I mean, I think that if everybody's poised to believe that a bigger downturn is coming, then it can be a self-fulfilling prophecy. But we haven't seen the data points leak into consumer confidence or strength of the consumer, things like that. And I feel like it may not happen anytime soon, but that would be the type of data that makes it less likely for that sideline money to chase, because it's going to feel like it's starting to see confirmation. And make no mistake about it, a bear market doesn't necessarily get its biggest moves down right after a massive flood of smart money investment. It becomes a boycott, and we're already in a boycott. And if we don't find anything to convert the non-believers, then the boycott just goes on. and you start to see the people who are already in the market just throw in the towel. So I think that confirmation of an economic downturn that's cyclical in nature, that's spread beyond the notion of whether or not the trade war is going to resolve itself, and has just gone into a generalized risk aversion in terms of households and banks and businesses and everybody, and it just it takes on a life of its own. And I think that that would be something that, whether the Fed cuts or not, would pull the rug out from underneath things.
All right. So, Brett, is there anything we're missing here? Is there any topics that you were hoping to discuss that I haven't broached yet?
No, I don't think so. And especially go ahead.
I was just going to throw out one thing I forgot to ask you about was your thoughts on the move in crude oil today.
I mean, it's pulled back to an identifiable zone that creates a kind of a range possibility. It's right at the level that I said earlier I thought would be more ideal, around 56.35. But it would need now to move back above 56, let's say 56.75, to get to the kind of situation where we've carved out a lateral range following the move higher, which could still be a bearish configuration on a larger time frame. And there's all sorts of headline factors that are going to enter into this. But, if you're a bull right now in oil, you need to see the puke that we saw down through the level, and it's exactly why I constructed my earlier comments. You saw the break that we just had maybe about, half an hour, 45 minutes ago. It was through the level that I initially identified as 56.60. That was the key level. And then I immediately followed up on that post, or added to the post, saying 56.35 would be more ideal, on the basis of the idea that this looked like it was destined to flush out that level, not just stop at it. But that necessarily means it's an overshoot. For the bullish configuration, it's an overshoot, and then it's repaired. So right now, if we start to see this market move back above 56.60 after that kind of emotional overshoot, it really sort of puts the anchor in there, and then you've got a lateral range maybe between 56.50 and 58, and then we'll see how that builds itself out and maybe breaks back down. But we've gotten the OPEC news, we've gotten the G20 news. That's in the market now, and we're consolidating. What's that?
OPEC was basically a non-event in your opinion, or?
It was absolutely what was expected.
Yeah, okay. But you're not planning on taking any actions in it?
No, I don't like to trade right in front of the two big data points. It's just a habit. I mean, I may after 10:30 a.m. tomorrow.
Okay. All right. Anything else then on the plate here, Brett?
No, and I think we should it should be a brief sentiment flow show, because quite frankly, the sentiment data is the same as we've reported, and then all the short-term measures are dead middle of the range.
Yeah, and we've got the G20 in the rearview mirror now, and OPEC. Right. So we could focus on obviously upcoming economic data. We'll certainly have a lot of volatility around it for the trading of the futures. I think anytime we beat or miss with the look forward at that Fed funds futures. But for me, earnings season remains the key, and like we're talking about, how much of this is due to sentiment and businesses just pulling back until they get a little bit further confirmation, and how much of this is actually a structural breakdown in different areas. So it's going to be one of the more interesting earnings seasons for sure, and it'll be fun to talk about the sentiment as we go through it and see how people are reacting to some of these reports.
Yeah, and as a final note, I just want to kind of start where we began, or end where we began, which is to say, if you were trading top down during the last several number of weeks, and you did well, I think that this is a time to avoid a bullet, because I think that you're going to, if you just carry on with momentum, if you had a good June, you can start to feel like, hey, it's easy. I'm just going to keep doing this. It's going to be great. I'm going to buy that sports car pretty soon, et cetera, et cetera. Then I think that we may be heading into a situation over the next couple of weeks that's a real problem for you. So I would just say increase your selectivity and reduce your activity until you start to rebuild the sense of a new compelling type of setup.
Yeah. All right. Well, Brett, thanks for joining us here. Real quick, you think you're going to be busy the next few days, or?
I do not.
Yeah.
It's possible.
It's possible.
I will be watching.
Yeah, we'll be watching, but we're not going to press the trades, I guess would probably be the best way to look at it. So if there's anything out there, we'll be sure to let you know. But Brett, always a pleasure talking to you, and look forward to talking to you next week, see if anything's changed here.
Thanks, Gav.
All right, talk to you soon.